Equity Market Update, September 2019. In September 2019, Indian equity markets appreciated by approximately 4%, driven by the government's decision to cut the base rate of corporate taxes to 22% from 30%. Other developments like attacks on Saudi Aramco facilities, rate cut by the US Federal Reserve, trade war tensions, etc. were key developments during the month. Sectoral indices performance was mixed, with oil and gas and capital goods outperforming and IT and healthcare underperforming. Large caps continue to outperform mid and small caps in the current month. Globally, equity markets fared well in September. All major indices in the US, Europe and major Asian markets delivered positive returns in the month amidst optimism around US-China trade deal and easing global liquidity. During the month, Brent crude prices were largely flat and closed at $60.8 per barrel despite the volatility during the month due to concerns over supply caused by the attack on Saudi Aramco's oil facilities. Prices of most major commodities were also flat except gold and zinc. INR appreciated by 0.8% against USD and closed at 70.9. FPIs were net buyers in the month and bought equity of $1.1 billion in September. Total FPI's equity inflows in H1 FY20 have been close to $1.4 billion. Net inflows in domestic equity-oriented mutual funds were 9,043 crore rupees in August 2019, compared to 10,260 crore rupees a month ago. For FYTD20 till August, total flows in domestic equity-oriented mutual fund stood at 28,895 crore rupees. Given the slowing growth, government announced reduction in corporate taxes as well as lower taxes for new manufacturing companies. Companies currently enjoying tax benefits or holidays can avail the lower rates once the holiday period is over. The new manufacturing company should be incorporated on or after 1st October 2019 and commence production before 31st March 2023 and should not avail any exemption or incentive. Enhanced surcharge introduced in the budget shall not be applicable on capital gains on sale of equity shares or mutual fund units for domestic as well as foreign investors. This is a path-breaking step which is likely to boost corporate profitability and improve sentiments. With Indian tax rate now competitive with other countries like Vietnam, Singapore, Thailand, China, etc., it can act as a big catalyst to attract fresh investment from foreign and domestic players over medium term. The timing is particularly opportune given the backdrop of rising US-China trade tensions and many companies looking out to relocate their manufacturing base out of China. As on 30th September 2019, Nifty 50 is trading at price-to-earnings multiple of 20.3x based on FY20 estimated earnings and 16.5x based on FY21 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. Markets thus hold promise over the medium to long term in our opinion. With the sharp decline in mid-caps and small-cap stocks over the past 15 to 18 months, significant divergence with large caps is not likely going forward. Adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. It is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly and it is now below the 10-year average. This indicates that equity markets are attractively priced. In view of the above and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Debt Market Update, September 2019. The 10-year benchmark G-Sec yield ended the month of September at 6.7%, up 14 basis points over the previous month end. Average interbanking liquidity continued to remain positive for the month due to higher central government spending and tepid growth in currency in circulation. Net FII debt flows turned negative, with net outflow of $0.1 billion during the month, compared to net inflows of $1.6 billion in August 2019. In the first half of FY20, aggregate net FII debt inflows stood at $3.5 billion, as against net outflows of $6.9 billion in the corresponding period a year ago. INR appreciated against USD during the month by 0.8% and ended the month at 70.9 on back of positive equity flows. Annual rate of retail inflation, CPI, was largely stable at 3.21% in August 2019, up 6 basis points month-on-month. Food inflation increased to 2.96% from 2.33% a month ago. The rise in food inflation was largely offset by the lower fuel and core CPI. Core CPI moderated on back of lower education and household services inflation, partly offset by rise in personal effects due to increase in gold and silver prices. India's current account deficit improved in Q1 FY20 on year-on-year basis, primarily due to stable net oil imports and lower deficit ex of oil and gold. This was aided by improvement in net invisibles exports, led by improvement in software services, and was partially offset by higher trade deficit on account of gold imports. Balance of payment was in surplus at $14 billion for the quarter, on back of strong FDI flows of $13.9 billion and FII flows of $4.8 billion. Foreign exchange swap done by RBI in April 2019 also helped. During the month, the government announced to cut the base corporate tax rate from 30% to 22% effective April 1, 2019 for companies which are not availing incentives or deductions. Further, the government also reduced the base tax rate to 15% for manufacturing companies incorporated after October 1, 2019 and which commenced production before March 31, 2023. Minimum alternate tax will also not be applicable on such companies. Government estimates that these tax cuts are likely to result in gross revenue loss of 1,450 billion rupees for FY20. Fiscal deficit for FY TD August 2019 stood at 78.7% of FY20 budgeted estimates, less than 94.7% during the same period last year, mainly on account of higher RBI dividend. However, the growth in gross revenue remains muted at 4.2%, with direct tax collections growing at 9.6% and indirect tax collections growing by 0.7% only. With recently announced corporate tax rate cut, direct tax collections might moderate further, and thus risk of fiscal slippage remains high. Monetary Policy Committee, in its bi-monthly meeting held in October 2019, reduced the policy repo rate by 25 basis points to 5.15% while maintaining an accommodative stance. The reverse repo rate now stands at 4.9% and the cash reserve ratio remains unchanged at 4%. This was the fifth consecutive rate cut by RBI, and it has reduced the policy rate by 135 basis points in aggregate since February 2019, though the transmission remains muted. Outlook. The MPC's decision to reduce policy rate by 25 basis points was largely in line with consensus expectations. RBI also mentioned that it will continue with an accommodative stance as long as it is necessary to revive growth, while ensuring that inflation remains within the target. Given the near-term inflation outlook remains benign and growth is slowing, it could provide some space for further policy easing. However, given that RBI has already cut rates by 135 basis points, any future action by RBI is likely to be data dependent. Further, with the surprise cuts in corporate tax rates, the fiscal concerns of market have crystallized. Additional dividend from RBI might cushion the impact, but fiscal deficit might still increase by 0.3 to 0.4% of GDP. Going forward, yields may trade within a range with some downward bias as conflicting forces are at play. On the positive side, factors such as moderation of global growth due to trade war tensions, softening global commodity prices, easing stance of major global central banks, slowing domestic economic activities, benign inflation and high real yields in India favor lower yields. On the negative side, possible increase in fiscal deficit on back of corporate rate tax cuts, excess statutory liquidity ratio investments within banking system, volatile FII flows, etc. might impact yields adversely. However, in our opinion, most of the aforesaid factors are largely priced in, and scope of significant move on either side from here on seems limited. Considering the aforesaid factors in our assessment, the short to medium end of the yield curve offers better risk-adjusted returns. Hence, we continue to recommend investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.